Hello, my name is Fabian Ding. I am the owner of FMD Wealth Advisors. This is my podcast, Don't Screw Up Divorce. I'm a certified financial planner, chartered financial analyst, enrolled agent with the IRS, certified divorce financial analyst, and certified Quattro specialist. I help people that are going through major life transitions like divorce. I am supporting my clients before, during, and after the divorce and work with clients nationwide. If you would like my help, click the link in the show description or visit fmdwealth.com to schedule a call with me. We are open for business. So now, what is this week's topic? This week's topic is hidden assets in a high net worth divorce. How wealthy spouses conceal money and how forensic accountants find it. So in most marriages, financial visibility is uneven. One spouse usually handles the investing, runs the business, or manages the accounts. The other spouse is engaged at high level, but rarely sees the day-to-day detail. For most of a marriage, this is not a problem. It becomes a problem only at one specific moment: divorce. When a marriage ends, the spouse with less visibility into the financial picture is at an information disadvantage. And in a high net worth case, that disadvantage can be worth a great deal of money. Hidden assets in a divorce are not always the result of deliberate concealment. Sometimes they are simply assets the less engaged spouse never knew existed. Sometimes they are assets that have been shifted in the months or years leading up to the filing. Sometimes they are very much intentional. Whatever the source, the forensic work of identifying and valuing the full marital assets and estate is one of the most important pieces of a high net worth divorce. It is also one of the areas where having a financial advisor and a forensic professional on your side most directly protects your settlement. So what hidden actually means in this context? Let's talk about that. The phrase hidden assets sounds dramatic, but it covers a wide range of behavior. At one end are assets that simply were not disclosed because the other spouse never thought to ask. On the other end are assets that have been actively moved, retitled, or buried. In between sits the much more common category: assets that have been quietly minimized. A business with cash flow that has dropped in the year of filing. A bonus that payer's employer has been asked to defer. A side venture that has been temporarily de-emphasized. A real estate holding that is suddenly listed at a lower valuation than its appraisal would support. From a legal standpoint, the court is concerned with the full economic picture, not just what shows up on the balance sheet. If an asset's reported value or an income stream reported amount does not reflect economic reality, the law gives the court room to look behind it. Recognizing the spectrum is the first step. The second is bringing in the right professionals to do the looking. So let's talk about the net worth statement. The net worth statement is your foundation. Every divorce case in New York requires both parties to file a sworn net worth statement listing income, expenses, assets, or debt under oath. The official New York net worth statement form is the foundational document of the financial side of the case. This document matters in two ways. First, it forces both spouses to put their financial picture on the record. Second, and just as important, it locks in those representations. If a settlement is later reached based on the net worth statement, and one spouse is later found to have lied, the agreement can be reopened. Settlement agreements in high net worth cases should explicitly state that the parties have relied on the representation in their net worth statements. Without that language proving that the other spouse lied later and that the lie affected the deal becomes much harder. Filling out your own net worth statement carefully with documentation behind every line item is one of the most important pieces of preparation in the case. So let's talk about what forensic accountants actually do to find hidden assets. A forensic accountant in divorce is not just an accountant who happens to be involved in legal matters. They are specialists in tracing money, reconstructing income, and identifying inconsistency in financial records. Their work typically includes tracing transfers between accounts, identifying unexplained deposit or withdrawals, reviewing business records for understated revenue or overstated expenses, comparing reported income to lifestyle expenditure, and producing an independent valuation of closely held businesses or hard-to-value assets. Forbes has a useful overview of why a forensic accountant belongs on your divorce team. And the reasons its list track closely with what most experienced matrimonial attorneys will tell you. In a case where a business is at issue, a forensic accountant can also distinguish between the income the business produces. One of the most powerful tools in identifying hidden assets and income is the so-called lifestyle orders. So, numbers can be adjusted or manipulated, but lifestyle is much harder to hide. So what does that mean? So if a spouse reports, for example, $300,000 of income, but the household routinely spends $600 a year on observable expenses like mortgage, taxes, private school, travel, dining, automobile leases, the gap has to come from somewhere, right? Mathematically, it has to come from somewhere. So either there is undisclosed income, undisclosed credit, or assets being quietly liquidated to support the lifestyle. So comparing reported income against actual household spending over several years often surfaces patterns that no individual document would. It is one of the first analyses any experienced forensic accountant will run, and it produces evidence that is straightforward for a judge to understand. If you are the less engaged spouse, your knowledge of how the household actually lived, where you traveled, what you spent, what was bought in cash, is a meaningful evidentiary asset. Document what you can while it is fresh. So what are some common concealment patterns in high-income cases? So forensic professionals see the same pattern repeatedly in high-income divorces. None of them are conclusive on their own, but together they form a recognizable picture. For example, income suppression. A business owner's reported income unexpectedly drops in the year of filing, often through deferred billing, accelerated expenses, or temporarily reduced effort. A W-2 earner asks their employer to defer a bonus with no written request that can later be subpoenaed. Friendly transfers. Money is moved to a sibling, parent, or business partner under the assumption of a loan or investment, with an unstated understanding that it will return after the divorce. Asset undervaluation. A business is presented at a value that ignores its real cash flow. Another thing is a second home is appraised conservatively. Collectibles, art, jewelry are listed at a fraction of insurance values. So an experienced forensic accountant looks for those patterns directly. The earlier they are engaged, the more time they have to trace what they find. So when to spend on forensic work is a big question. Forensic accountants are not inexpensive. Their work in a high net worth case can run from several $1,000s to well into the six figures, depending on the complexity of the case. The right way to think about that cost is as a percentage of what is at stake. Spending $50,000 on forensic work to recover $500,000 of hidden value is a real return. Spending $50,000 to verify a straightforward W-2 household with one income and one house is usually not. If you are the less moneyed spouse and you cannot afford the forensic engagement out of pocket, New York courts can order the more moneyed spouse to contribute toward experts, witness fees, as well as counsel fees. The application has to be made early and has to specifically identify the expert work being requested. The decision to invest in forensic work is one of the clearest places where a financial advisor perspective is valuable. They can help you size what is at stake and decide whether to spend the money or not. So let's talk about information. That's basically what we want to get out of the forensic work, right? So information is the ultimate leverage in every case. In a high net worth divorce, the side with the better information usually wins. Not always in the dramatic courtroom sense, but in a quieter, more important sense of negotiating a settlement that reflects the actual marital estate. Hidden assets are not always hidden in the way that words suggests. Often they are simply not visible from where you are sitting. Bringing in the right forensic and financial professionals turn invisible assets into visible ones, and that visibility is what gives you the leverage to settle on fair terms. If you suspect there's more to the financial picture than you are seeing, trust that instinct. The cost of investigating it is always almost smaller than the cost of leaving it uninvestigated. So let's focus on some frequently asked questions that I receive from my clients. I trust my spouse. Do I really need this kind of investigation? Trust is a personal question. Documentation is a separate one. Even in amicable divorces, both parties should complete a sworn net worth statement and should sign a settlement agreement that referenced the reliance on those statements. That is not a sign of distrust, it is basic protection against errors and against future disputes. Whether you go further into forensic territory depends on the complexity of the estate and what your own instincts are telling you. Next question. What happens if my spouse is caught hiding assets? Well, New York court have significant discretion to remedy concealment. So the court can award the non-offending spouse a greater share of the disclosed assets, for example. Furthermore, it can order the offending spouse to pay counsel and expert witness fees, and in some cases can impose additional monetary sanctions. In serious cases, the court can also treat the hidden assets as if they still existed in the marital estate. Okay, last question. Can I reopen my divorce later if I find out assets were hidden? Possibly. New York applies a statute of limitation based on fraud, which generally runs from when the fraud is discovered or could have been discovered with reasonable diligence. If your settlement agreement specifically referenced reliance on a net worth statement that turns out to be false, you may have grounds to reopen the case. The strength of that case depends heavily on the language of the agreement and the evidence of the concealment. Moving quickly, once concealment is discovered, is crucial. So, this was this week's podcast, Don't Screw Up Divorce. My name is Fabian Degen. I am the owner of FMD Wealth Advisors. I'm a certified financial planner, chartered financial analyst, enrolled agent with the IRS, certified divorce financial analyst, and certified Quattro specialist. I help people that are going through major life transitions like divorce. I'm supporting my clients before, during, and after the divorce, and I work with clients nationwide. If you would like my help, click the link in the show description or visit www.fmdwealth.com to schedule a call with me. We are open for business.